Hello, everyone. And it's only been a short stretch since markets were once again told that lower rates were right around the corner. But since then, the whole picture has started to look far less comfortable, with inflation heating up again, long-term Treasury yields pushing higher, government borrowing harder to ignore, and households being squeezed. So in this video, I want to make sense of what is happening by walking through why interest rates may become the pressure point that exposes the weakness in the economy, what the latest inflation, debt, labor, and lending numbers are telling us, and why the next phase could be much more disruptive than people expect. Today is Sunday, May 17th in New York. What day and date are you watching from? And if you value this kind of straight market breakdown, support the work by subscribing and commenting, Our John AG. So, jumping in, the first thing to understand is that the rate story has changed. For months, investors were encouraged to believe that inflation was fading. The Federal Reserve would be able to ease policy smoothly, borrowing costs would cool off, and the economy would glide into a softer landing. But the latest numbers don't fit anymore. Based on recently published numbers, consumer inflation accelerated again in April, with the headline rate moving back into the high 3% range on a yearly basis. Monthly price growth also came in hot, and energy played a meaningful role, but the problem wasn't limited to gasoline. Shelter, household expenses, personal care, airline fares, and several everyday categories kept moving higher as well. That matters because the public conversation keeps acting as though inflation is basically defeated. It isn't. It may be lower than the worst period of the last cycle, yes, but that is not the same thing as price stability. The economy is still dealing with a cost structure that rises too quickly for many households, and now the pressure is showing up while borrowing costs remain elevated. High inflation by itself is painful. High rates by themselves can be manageable for a while, but high rates sitting on top of sticky inflation create a much harsher environment because families, businesses, and the government all feel the squeeze at the same time. Now here's where things get more serious. Long-term yields have been climbing, and they have climbed enough that the bond market is no longer whispering. It is getting louder. From recent market updates, the 10-year Treasury yield recently moved into the mid-4% area, while the 30-year yield pushed a bit above 5%. Those levels matter because they influence mortgage rates, corporate debt, credit conditions, federal interest expense, and the valuation of nearly every major asset class. When the long end of the Treasury market stays elevated, the whole financial system has to reprice around it. That is what makes this moment so fragile. The United States spent years getting comfortable with cheap capital. Homebuyers, corporations, and Washington all benefited from easier financing. But that world has changed. Older debt rolls over, new borrowing costs more. Every renewal is a reminder that yesterday's easy money conditions are gone. This is why I think the real risk is not just that rates stay high. The bigger risk is that rates become the transmission channel through which weakness spreads. Housing slows because monthly payments stay punishing. Commercial borrowers become more cautious. Smaller businesses lose room to maneuver. Consumers rely more heavily on revolving credit. Banks respond by becoming stricter. And once that loop starts feeding on itself, the economy can deteriorate even if the stock market tries to pretend everything is fine. According to the latest publicly available lending survey, banks tightened standards for business loans during the first quarter, while demand weakened in several household credit categories. That is not collapse by itself, but it does tell us something important. Credit is becoming less generous while households are already stretched. When banks pull back, fewer people get approved, fewer projects get funded, hiring slows, spending softens, and earnings pressure follows. We're already seeing hints of that. The labor market is not falling apart, but it is less convincing than the surface-level talking points suggest. Payroll growth in April was positive, yet modest, and federal employment continued to decline. More importantly, the broader pattern over the prior year showed much less momentum than the economy had enjoyed earlier in the cycle. Jobs are the final support beam for consumers. As long as paychecks keep coming in, households can absorb higher prices and interest expense. If hiring fades further, that shield gets thinner. And don't miss what is happening on the spending side. Retail sales rose in April, which at first glance sounds healthy. But the headline is not the full story, because those sales numbers are measured in dollars, not in purchasing power. When prices are higher, sales totals can look stronger, even if people are not walking away with much more actual value. That is one of the most misunderstood features of inflation. Nominal activity can stay firm, while living standards quietly erode underneath. The same dynamic applies to personal spending. Recent data showed outlays continuing to rise, but the inflation gauges that matter to policymakers also moved higher. The Personal Consumption Price Index returned to the mid-3% area over the year, while the core measure also remained above comfort levels. So consumers are still spending, yes, but they are spending into an economy where the cost of staying afloat is rising. Sometimes people spend more because they are thriving. Other times they spend more because the same groceries, insurance premiums, repairs, and bills simply cost more. Now, let's bring the Federal Reserve into this because that is where a lot of people get misled. There is a popular idea that the central bank can simply cut interest rates whenever the economy weakens and make the problem go away. I don't think it is that simple this time. If inflation is still running too warm, aggressive rate cuts risk reviving price pressures even further. But if the Fed refuses to cut while growth deteriorates, financial stress can build. They are trying to support the economy without appearing reckless on inflation, and the room for error is much smaller than it was in prior cycles. The balance sheet adds another layer. Based on recently published numbers, the Federal Reserve's total assets are higher than they were near the start of the year, even though they are still far below the extraordinary peaks reached in the aftermath of the pandemic era. That detail matters because the direction has shifted enough to get attention. It does not prove a full return to large-scale easing by itself, and I want to be fair about that. But it does show that the system is no longer moving in a clean, one-way tightening pattern. If market stress rises sharply, the pressure to provide liquidity could return fast. And that takes us to the federal government, because the debt burden is where higher rates become truly dangerous. From recent fiscal projections, the deficit for this fiscal year is expected to be near $2 trillion, and debt held by the public is projected to keep rising as a share of the economy over the next decade. The key point is the direction. Washington is borrowing heavily even outside of a full-blown emergency. That means interest expense becomes harder to control as older debt is refinanced and new deficits stack on top. This is how the trap forms. The government needs to borrow more. Investors demand better compensation for taking that debt. Higher yields raise future interest costs. Higher interest costs widen deficits. Wider deficits require more borrowing. And then the cycle repeats. People often talk about debt like it is a distant problem for future generations, but interest expense is a present tense problem. It competes with defense, entitlements, infrastructure, and every other spending priority right now. Now, I want to challenge one common assumption. Some people argue that rising rates automatically mean the dollar becomes stronger, and therefore the United States is safer than it looks. There is a little truth there in the short run. Higher yields can attract capital. But that argument breaks down if investors start focusing less on yield and more on fiscal credibility. A government can offer a bigger coupon, but if the market begins to worry about inflation, political dysfunction, and endless borrowing, higher yield stops looking like a reward and starts looking like compensation for growing risk. That is why I do not think this can be explained only through politics, even though politics shapes policy. The deeper issue is structural. The economy has been operating with large promises, heavy debt, and a public expectation that every slowdown can be managed without meaningful sacrifice. Interest rates are now testing that assumption. Social Security gives us another window into the same problem. The latest trustees' summary still points to depletion pressure in the old age trust fund during the next decade, with less than full scheduled benefits payable if lawmakers do nothing. That does not mean checks vanish overnight. It does mean the system is entering a period where delay gets more expensive. Younger workers cannot assume every retirement promise will arrive exactly as advertised. The longer reforms are postponed, the uglier the trade-offs become between taxes, benefits, and borrowing. If you're successful, share your success story in the comments so others can stay motivated. Now, let's connect all of this back to households because this is where the economic story becomes real. Consumer credit continued to expand in the first quarter, and revolving balances picked up faster in March. That tells me many families are still leaning on debt to bridge the gap between income and expenses. At the same time, recent stability updates have noted that auto and credit card delinquencies remain elevated compared with much of the past decade. That is not a blanket crisis, but it is a warning light. When borrowing costs stay high and essentials remain expensive, even a small shock can push vulnerable households from coping into falling behind. This is why I believe the economy can look stable right up until it doesn't. Corporate earnings may hold up, major stock indexes may rally on optimism, policymakers may point to headline employment, but beneath that surface, the pressure builds in quieter places first. Payment delinquencies, tighter lending standards, fewer refinancing opportunities, slower hiring plans, weaker confidence among smaller firms, and more stress in rate-sensitive sectors. The visible break usually comes after the invisible damage is already spread. Now let's connect this to gold, silver, and mining companies. I want to be careful because owning metals is not magic, and no asset moves in a straight line. But historically, when confidence in currency purchasing power weakens, when fiscal strain deepens, and when investors begin questioning whether policymakers are trapped, hard assets tend to attract more attention. That doesn't mean every rally is justified or every miner is attractive. It means the macro backdrop becomes more supportive for assets that are not someone else's liability. Gold in particular is often treated as an old-fashioned relic until the financial system starts showing stress. Then suddenly people remember why it mattered for centuries. It has no earnings report, no board of directors, no political campaign, and no promise attached to it from a government that may spend more than it collects. No gain is guaranteed. But it explains why demand for monetary alternatives tends to rise when debt concerns stop sounding theoretical. Silver is different. It carries both monetary appeal and industrial exposure, which can make it more volatile. Mining stocks are different again because they are businesses, not metals sitting in a vault. They can offer more upside in favorable conditions, but they also introduce management risk, jurisdiction risk, operating cost risk, and dilution risk. So I would not casually lump all of these together. Still, in an environment where real returns on cash may be pressured and trust in policy becomes less certain, it makes sense that investors increasingly look beyond traditional paper claims. Foreign currencies come up in this conversation as well, and here people need balance. The dollar can weaken over time without every competing currency becoming wonderful. Many economies face their own debt, aging, and growth problems. The stronger argument is to think in terms of purchasing power and resilience, not simply the number of dollars visible on a statement. This is where the broader market narrative becomes dangerous. The public is told to cheer when asset prices rise, even if the cost of living rises too. They are told the economy is strong because indexes are near highs, even if financing a home, a car, a business, or a college education feels heavier. They are told inflation is cooling, even while recurring expenses keep climbing. That disconnect creates complacency, and complacency is exactly what gets punished when a rate shock finally bites. As we wrap things up, my position is straightforward. I am not saying every weak data point guarantees a crash tomorrow. I am saying the economy is carrying more interest rate sensitivity than people admit, and the cushion is thinner than it appears. Inflation is not fully beaten, Treasury yields are elevated, credit is becoming less friendly, government borrowing is enormous, retirement promises are under pressure, households are leaning harder on debt, and the central bank may not have an easy escape route if growth slows while prices stay stubborn. So the question is not whether higher rates matter. They already matter. The real question is how much stress the economy can absorb before the damage becomes impossible to dismiss. Do you think the next downturn comes from the labor market, the bond market, or household debt finally snapping under pressure? I'm wishing you all a steady week ahead. Please take care of yourselves and take care of each other. Leave a like if this breakdown helped, subscribe so you don't miss the next update, and share this with someone who is still being told that rates are just a background issue. And one final note, this is educational commentary meant to help you think more clearly about the economy. It is not personal financial advice, and every decision involving your money should fit your own situation, goals, and risk tolerance.